Even if you have no intention of ever trading an option, you should understand the options marketplace has a very large impact on the overall marketplace. If you pull up a graph of VXX and you zoom out to a 10-year line, you see this thing just die, right? It just goes down all the time. And you think to yourself like, well, it'd probably be pretty cool if I could short that. Then you zoom in a little bit and you'll see, well, wow, this thing goes up, 2, 3, 400% every now and then. And if I'm short it, I'm going to lose all of my account. So the trick is, how do you make money being short volatility without getting blown out when volatility goes up? The large market making firms are filled with guys with, 900-pound heads, right? They're super smart guys. And what is the chance that this community overall is just so dumb, they're going to keep buying options from some ETF company for terrible prices for them? It just doesn't make any sense.
Welcome to Excess Returns. I'm Jack Forehand. I'm really excited today because I'm joined by Noel Smith. Noel is the co-founder and chief investment officer of Convex Asset Management. And for a boring value guy like me, this is a pretty interesting set of topics today we're going to talk about. We're going to talk about volatility trading. We're going to talk about dynamic allocation. We're going to talk about regime changes in the market and how Noel measures those. And we're going to talk about using options for income, which is a strategy many of us have seen in a lot of ETFs these days. We might even get a little bit in the current market environment and what Noel sees there. So Noel, thank you for joining us.
Hey, I'm excited about being here. Thanks for having me.
We don't usually do background on our guests, but I wanted to do it today because you've had probably the most diverse set of experiences, potentially of anybody we've had on here. You were a biochemist, you were in the Army, you were at the forefront of the advent of high frequency trading, you were a prop trader, and today you run a hedge fund. So before we get started, I was wondering if you could just talk a little bit about all that and how it got you to where you are today.
Sure. So funny enough, the military experience and also having a degree in biochemistry ended up working into trading because my biochemistry background gave me an opinion on COVID and my military experience gave me an opinion on high frequency trading. So I'll talk about that in a minute. I started out on the floor of the CBOE in the 90s. I was a market maker and my partners and I spun out of Susquehanna, which is another market making firm. And we were basically just pit traders in the beginning. There was just a few of us. And eventually I ended up backing probably around 100 different guys across the country. We had guys at the NYMEX, the COMEX, the Amex, the Board of Trade in Chicago, the CBOE, the Mercantile Exchange. So we had, kind of guys wherever we thought it matters, trading Eurodollars, trading bonds, all that kind of stuff. And fast forward a little bit of time, we had a little bit of adversity around the Thai bot or LTCM. I forgot exactly what it was, but, late 90s. And we had this guy working for us and we lost a bunch of money. And I said to him, I'm like, hey man, your job is secure, but we don't have any money to pay you. So if I were you, I'd quit. And he's like, okay. And so he came back to us with another guy, his partner, and they wanted to start a company called GetCo. And they wanted some money for that company. And it was a high frequency trading idea. And so what it really was the nexus of the two things I had an opinion on, which was signals and communication systems, which is what I did in the military, and trading. So I was uniquely suited to have an opinion on that idea. And so we decided as a group to make an investment into that company called GetCo, which ended up buying Knight Capital. And then that is now Virtu. And I have nothing to do with Virtu, but that was the genesis of HFT in the United States, which was a pretty cool thing to do. And then from there, I started thinking about launching a hedge fund in 2004 or something like that, because, I had people in my orbit that said, hey, I think, you're doing pretty good. So, can I give you some money and, can we do this a little bit more substantially? In launching a hedge fund, you dilute the returns. It's not all easy. There's admin, there's accounting, there's all these compliance things you have to consider. So it's not just a simple function of, hey, do you want to make more money or not? It's more work and more money. And then, in 2019 or so, finally decided to do something about that. Probably should have done it in 2004, but we decided to launch a hedge fund in 2019. And that's what we have right now.
I'm just curious because you've had a front row seat to this for a long time. And as me, someone sitting outside of, markets, at least the inner workings of them, I don't see this a lot. What is the biggest thing you think has changed? If you look back from what you were doing at the beginning to what you're doing now, what are the major changes you've seen in markets behind the scenes that you think are interesting?
So everyone always says the golden era was 5 years ago. It's always 5 years ago, no matter what, time slice you're looking at. So when I started, the golden era was 5 years ago, and 5 years from now or 5 years ago. So the biggest thing that's changed is the liquidity and the spread size and the ease of which information can be had. Everything is just easier and better. So the idea that, everybody used to make so much money trading options or whatever else is just nonsense. There's a survivorship bias that you see, and the guys that are still around probably did pretty good. But the guys that aren't around that, just blew out of the business for whatever reason, those guys are gone. And so you don't get that sample. Those guys have fallen out of your sample set. But the spreads used to be 25 cents wide, 50 cents wide. And say you wanted to do a four-legged iron condor, you're looking at a $2 or $3 wide quote between the bid and the offer. That stuff doesn't exist today. The idea that you would have a penny wide Apple options, no way. To penny wide for 10,000 options either side, no way. There's nobody was willing to fill that kind of size for that kind of narrow of a width. So it's improved, and the access to information has never been better. All the stuff that used to be in-house for a prop trading firm like mine, you can kind of Google it now, or you could go to ChatGPT and get that information. Or there's just so many different ways that you can do things that really were cutting edge stuff, 10, 15, 20 years ago is, kind of available and commoditized now.
I want to ask you more about how that information being out there affects what you do. But first, I want to get into what you do, because much of our audience probably won't understand or have exposure to what you do. So is calling what you do like a volatility hedge fund? Is that the right way to phrase it?
We're a hedge fund. We use volatility as a way to figure out what to do, but it's not necessarily what we end up doing. So, it's kind of like when we're reading the tea leaves, some people are looking at, maybe a balance sheet, or they're looking at, esoteric data as a way to kind of get to their endpoint judgment. And we look at volatility, and the simplest reason is because we think it's the best information that's out there, because some of the most informed paper, the most informed trades come from the options market, because that's where you get the most gearing. That's where you get the most leverage. And it also has kind of a forward component to it. So if you're looking at something like macro data, like non-farm payrolls or something like that, that data is already old. And, you're looking at the same data, and you get it at the same time that everybody else gets it. So it's not necessarily that much more useful unless you're able to better predict it than anybody else. But the options market is looking in the future, and you don't really see that in a lot of other ideas. So we're looking at volatility and options pricing as a way to get what we think is the best quality information to give us actionable judgment.
And so volatility sits above that. That's kind of your starting point of looking at what's going on in volatility. And then from that flows a bunch of individual strategies that you run.
Correct.
So we're going to dig into each of those individually in a second. But first, I wanted to ask you about what I just talked about a minute ago, which is this idea that information is out there now more than it used to be. How does that affect someone like you? I mean, is it harder to run these strategies now that more people have information, or do you just do it in a different way and it's really not harder?
It's really not harder. It's in a lot of ways, it's easier because I can scale bigger than I've ever been able to scale. I can do more than I've ever been able to do. And there is still so much to know. And there's so many levels of cleverness that can be done within this space that I feel like it's easier than it's ever been in a lot of ways. If we wanted to buy 500 options back in the day, that was a big order, and we had to shop that around or whatever else. Now I can buy 5,000 on the screen. I can just click a button and send, boom, buy 5,000 options. How many do you want? You want 5,000 more? No problem. And that just didn't exist. And how you get there, why do you want to buy 500 versus why do you want to buy 5,000? That can be a little bit more challenging. And some of the things that we used to do that were clever are less clever now because more people are doing them. So the edge has eroded on some of those trades. That's fine. We've also, evolved along with the marketplace with that. So it really hasn't been a problem at all.
So one of the cool things you have is you have this idea of a regime shift model. And then that sits above a lot of the stuff you do. And so I wanted to get into that a little bit, and we'll put up a chart in a second as to what's that seen in the market over time. But first I want to get into why you have that. Why do you think it's important to have different regimes and to maybe do different things inside of different regimes?
So thinking about volatility as an indicator, not price. So if you're thinking about price, say the S&P 500 is at 6,600 or something, right? And you own it. Well, you want it to go up. And if it goes down, you lose money. If it goes up, you make money. It's very simple. And if it doesn't go anywhere, nothing happens. But options have this other different dimension to them, which is implied volatility, and there's a function of time in there. And what you're getting from that is, again, more information, and it's allowing me to see things that are unseen in price. So going back to me backing guys. So because I've backed a lot of guys, I've seen a lot of different trades. And what this has allowed me to do is look at different strategies over time and just kind of common sense through, well, sometimes things work better than other times, right? Say you're trading anything, XYZ, lumber, gold, lean hogs, whatever. there is a time and a place where each one of those ideas will have a superior opportunity set than other times. So with that, it's not fair or accurate to say that, trading gold is always good, because there's long periods of time where it does nothing or it goes down. Or trading bonds is always good, or there's long periods of time where it does nothing or goes down. But if you can dynamically shift between opportunities when things are going to be going the way you want them to, which is up, down, or sideways, depending on what you want, then you can maximize the output of that work. And that's why we want to do this. We want to basically only buy umbrellas before it rains. Okay, well, how do you know that? Well, once you understand how meteorology works, I'm making this up on the fly, you understand that there's a barometric pressure, and as the pressure starts to change, and that will start to cause a wind, and that wind might, create some kind of a temperature inversion. Well, maybe you should go umbrella shopping. And it's the same thing with volatility. Volatility starts to express itself in the marketplace, and you can see these things in real time, and then you can make other different decisions in the marketplace based on what's happening around you.
And we'll put this chart up. So these are volatility regimes, right? These are not regimes like someone like me might think about them as, bear market or bull market. The market's going up, the market's going down. These are volatility regimes you're looking at. Is that right?
That's correct. What you're looking at is our internal output of our IP, intellectual property, insofar as we are labeling these things green, yellow, red. And we did it to make it really simple for investors to see, because green, good, yellow, maybe, red, bad, right? It's dead simple. So with that, if it's red, we have identified that as being a reduced risk or risk off regime. Yellow is kind of a blend, and green is just steady as she goes. Let's move forward.
And is this primarily focused on equities, or is this across asset classes that you're looking at this?
It's primarily focused on equities, but that logic applies to several different things. It can apply to bonds, it can apply to, commodities, or all kinds of things. But the options and the vol personality of a lot of different products, they also change. Like the bond skew can flip, it can be symmetrical, it can do all kinds of things. And equity skew is typically down. Sometimes it goes up a little bit or whatever, and it's a lot more predictable. But the personality of something more esoteric like oil or like bonds can be quite dynamic. So it's not exactly the same, but the logic can be the same, but the actual expression of the trade can be different.
So when you look at this, how are you thinking about, as someone who's running a bunch of strategies, how are you thinking about how to use this? So you're looking at each of the individual strategies you run, and then you're deciding what regime am I in and how do I deploy that strategy? And that changes based on what you're seeing here. Is that right?
That's exactly correct.
So the second chart is looking at the different regimes and sort of the spread of returns, right? In those different regimes. So can you talk a little about what we're seeing here?
In the second chart, what we wanted to do was prove the accuracy of our plan, right? So if we say that it's red today, well, what happens, 5 days from now, 10 days from now, 30 days from now? And it turns out the data is totally accurate. What if we say the regime is green? Well, what happens again 5 days from now, 15 days from now, 30 days from now? And it turns out that's also good. Now, of course, there's going to be a spread of data. Sometimes it doesn't always work exactly the way we want it to. But in general, we're playing the law of large numbers, and we want these things to kind of play out, again, with many iterations. So what we're basically showing is two different concepts: what we have and how well does what we have work. And the proof is in the pudding. It's just right there. The numbers are the numbers.
Are these slow moving signals? I mean, thinking about options just as someone outside of options, I would think maybe they change pretty quickly, but is that accurate, or do these take time to change?
We look at things on a daily basis. So which is to say, whatever our book is today, we may have a totally different book tomorrow. So when people talk to us and they say that, we would like to see a sample portfolio, that's a typical investor question. I always say, okay, you can have today's, or do you want last Thursday's? Because they might not be the same, or they might be the opposite in some other different way. And the book tomorrow might also be different. So because volatility does change very swiftly, and we have different regimes that we're looking at, we have a fast indicator, a medium indicator, and a longer term indicator. And so we try to respond to those things pretty accurately. And, like anything in life, the fast stuff can be kind of head fakey. They might deke you out a little bit. The medium stuff has a little bit more stickiness, and the long-term stuff has a lot more stickiness. So we try to account for all of that.
And I know this is proprietary stuff, so you can't reveal it, but are these things you're seeing behind the scenes in the options market? Is that what's triggering these regime changes?
That's exactly right. So if you think about it, this logic really starts from the floor. And I know that, another guest you've had on before, Brent Kachuba from Spot Gamma, he talks about the idea of the flows in the marketplace and the idea that what's happening from the options market will affect what happens in the stock market. And let me explain to you why I think that has merit. As a pit trader, say there's just two guys in the pit, you and me, right? There's two guys in this pit, and I go to lunch. Fine, now there's one guy in the pit. It's just you. And you have $1 million in your account. That's it. And somebody comes in and they buy $1 million worth of, I don't know, Microsoft calls. Now you are spent and you've sold these Microsoft calls at, I don't know, 40 vol. And then I come back from lunch and I say, hey, how's it going? What happened? You're like, oh, I sold $1 million worth of Microsoft calls. And then that broker comes back into the pit and he says, I want to buy $5 million worth of Microsoft calls. And I look at you and I'm like, well, I don't know. You're like, hey man, I'm tapped out. I don't have any more money to trade with. So now what I can do is I can increase the price in which I want to sell this new tranche of Microsoft calls. And I also know, since he came in with $1 million, maybe he came in with $5 million. What makes to say he doesn't come in with $10 million in 10 minutes? So what I can do is I can use that new information as a way to scale into this position. And then I can use that to my advantage. I can sell at higher prices than you did. I will make more money than you did. If you and I both make money, I will make some multiple of what you had, because I can see your positioning, because I know what your bankroll is and I know what your max positioning is. And that same logic applies to the options market writ large, because what happens is that the market makers don't have this infinite bandwidth for options. So if there are $10 billion that want to buy tiny little options in the SPX today, well, 10 billion is not even that much, a trillion, whatever. There's not just an infinite amount of supply out there. So once you kind of figure out like what is the market's appetite for these ideas, then you can decide, okay, well, what is the next increment? And then you can decide how much more elasticity is there in that trade.
Yeah, the dealer flow stuff is really interesting for me. And I've learned a lot from Brent on that, because when I saw a lot of things I was seeing in front of me as someone just investing for the long term, like I had no other way to explain them besides something was going on, like Open Door or GameStop, or even maybe in the COVID situation where the market just happened to bottom and top both on like options expirations. It seems to me there's got to be some validity in that for those types of things to be going on.
So think about it in even simpler terms. Say you are a BMW wholesaler, okay? And you think the average price for BMW X is $50,000. And then a guy calls you up and says, hey, I want to sell you a BMW. You said, great, I'll pay $49,000. Now you own one BMW for $49,000. And you think you've made $1,000 because you think it's worth $50,000. Then he calls you back 10 minutes later, says, I want to sell you 5 more. I'm like, well, I wish you would have told me you had 6. Tell you what, I'll pay you 45 grand for the next 5. Now you own 6. Then he calls you back an hour later and says, I've got 30 more. And you're like, okay, that's a lot of cars. I'll buy them, but it's going to cost you. I will pay $40,000 for this next tranche of BMWs. Then he calls you back tomorrow. It's like, I've got 5,000 of these things to go. You're like, okay, now I have to decide, is everything I've done already trash? Is BMW radioactive? What do I do? Then you figure out, well, he's blowing out. You're like, okay, fine. I will buy all of your cars, but I'll pay $2 for them, whatever number, right? There's some number that you will do this business. That's exactly how the options market works. You have to figure out, why is your counterparty doing what they're doing? And once you're able to figure out some of that or their bandwidth, then you can really capitalize on that information to make it to your benefit.
Yeah, it's interesting. When you talk to options people, a lot of this is not necessarily quantitative. It's like you have to know who's selling and why they're selling. It seems like a lot of people that are really good options traders know that. And they just have connections behind the scenes where they kind of have a feel for what's going on like that.
That's the bad news. That's true.
So there's one more on the model before we move on to the next thing. So the model is green right now, right? Which indicates sort of a more of a risk on environment. Is that the way to look at it?
Yes.
Okay.
Yeah. So a risk on environment for us means something like, we have different trades that we put on. Some of them have beta to the marketplace, some of them don't. But if we want to be risk on, we think that is, in general, it's okay to have beta to the marketplace. So, SPY or SPY analogs or Q analogs, NDX, whatever. Those things are permissible in the book. In a green regime, we're fine just being in the market, collecting some money from our options or whatever else, but being in the marketplace. And that can shift tomorrow. It can shift later today.
So now we'll get into your individual strategies, because there's a lot of interesting components that go into what you're doing. And I want to start with this because I know you have a new product here, this idea of options and income, because that's something we're seeing more and more. People like me are seeing, call selling ETFs and put selling ETFs. And there's all kinds of different things that are going on that we're seeing. And your individual investors are more and more getting into these things. So I thought maybe before we talked about your product, it might be good just for you to give me a high level overview of what should people think about when they look at these products that generate options for income. What are the things to be concerned about? What are the red flags? Like, what are the things people should be looking at in general?
There is what you're getting and what you're giving. What you're getting is some amount of premium for your options. What you're giving is opportunity. So if you're selling calls, yeah, you're going to get the premium of that call, but what you might not get is the 15 or 20% rally that the market, like right now, there's the JP Morgan hedged equity collar that's trading today. It's going to trade at some point later today. So the short calls in that trade are at 65.05. So every number of S&P points above 65.05, all of the investors, which is like, $35 billion or whatever else, they're not making any money on that. So they have traded upside for less downside. Is, the typical choice. Or you could easily say something like, well, how about I just don't put as much money into SPY and I take the rest of it and I put it into bonds, which takes you back to like a 60-40 or something. So it is a trade-off. It is not necessarily evil and it is not necessarily, awesome. It's not free money. You're just trading opportunity. That's really all it is. If you're buying car insurance, you're saying, I'm going to spend, $2,000 a year for this car if I crash it. But if you don't crash it, you've wasted $2,000. So you've given something to get something. You're getting peace of mind and you're abiding by the law, but you're giving $2,000 for that. And there's a price on that makes that no longer economical. If you were spending $40,000 a year for car insurance, you probably wouldn't do it. And that's kind of how the options market looks at it too, which is like, okay, I don't want these stocks to go down any more than you do, so I have to price these puts accordingly.
Yeah, it seems like this idea that there's no free lunch in investing is a good idea to use across almost everything. Because one of the things I hate about people who sell call selling strategies is they kind of present them, as you said before, as like free money. So you've got this stock, if the stock doesn't go up, you're just getting this free money, but there's always a price you pay because the stock might go up. So there's always a price you pay for these things.
Yeah, and think about it. Everyone knows that the large market making firms are filled with guys with 900-pound heads, right? They're super smart guys. And what is the chance that this community overall is just so dumb they're going to keep buying options from some ETF company for terrible prices for them? It just doesn't make any sense. So of course they're buying them for prices that are useful to them, not to you. So you are giving up opportunity there. So the idea that you can sell billions of dollars worth of calls and just get free money is just nonsense.
So when you think about constructing a strategy in this space, how do you think about it and how is that different than maybe some of these simple approaches?
Okay. So the context is a little bit interesting. So we were basically just given access to some money and they said, okay, we have this existing put spread writing program. And it worked really well for a long time, but there was sometimes too big of drawdowns than what the client really wanted. So the client was a little unhappy with the size of the drawdowns. And so the group that was running that strategy came to me and said, hey, can you improve on this thing? I looked at it. I'm like, yeah, no problem. So what we were doing is we're optimizing the spreads. But then what we're really doing that's most clever is we're taking our regime modeling and we're applying it to the size and the timing of those spreads. So very simply, when you're selling a put spread in a green regime, we expect it to perform just fine. If you're selling put spreads in a red regime, we expect there to be losses. So we basically would pause the strategy if we're in a red regime. And in a yellow regime, it's a little bit more complicated because we might even want to add leverage depending on what we're seeing. But that's also a minority of the time. The majority of the time is going to be green, but the reds can be quite violent, and we try to sidestep those. Will we get caught for a percent or two? Sure, of course. But the idea that we take a 9, 10, 12% drawdown, very unlikely. It's possible, but it's very unlikely. So what we're really doing is we're just trying to apply our dynamic allocation model to a put spread writing program so as to increase the overall risk-adjusted return for the investors. That's the point of the trade.
So the idea is to find some areas, some regimes maybe where the strategy struggles and just do less of it during those periods and do more of it in a period where the strategy makes more sense. Does that make sense?
Yeah, that sounds a little too oversimplistic. So because I don't know when it's going to struggle, I can just identify the preconditions, the weather outside, it looks like it might rain. That doesn't mean it's going to rain, right? So sometimes you're right, sometimes you're wrong. But the preconditions that will exist very likely to create a drawdown, then we can sidestep those problems.
So I want to ask you about another strategy you use here, which is volatility harvesting. And this is something that probably many of our viewers won't be familiar with. So before we get into your strategy, I was wondering if you could explain what this is. Like what is volatility harvesting?
Volatility harvesting in its sense is like if you pull up a graph of, you say you type into your charting software VXX and you look at this ETF, which is a vol ETF, and you zoom out to a 10-year line, you see this thing just die, right? It just goes down all the time. and you think to yourself like, well, it'd probably be pretty cool if I could short that. Then you zoom in a little bit and you'll see, well, wow, this thing goes up, 2, 3, 400% every now and then. And if I'm short it, I'm going to lose all of my account. So the trick is, how do you make money being short volatility without getting blown out when volatility goes up? So what we're trying to do is basically be short volatility in a risk-defined way so that we have no ability to lose any more than we're willing to put on the table at any one given time. So we want vol to go down, but if VIX or volatility goes up a lot, we know exactly what we can lose at any one given time. And it is a way to extract money out of the marketplace when frankly, there's just nothing else going on. So if you're long SPY or long Qs and nothing's happening, so whatever, right? It doesn't necessarily mean anything to you. But what is happening when nothing's happening is volatility is compressing. And it's another way to extract alpha from the marketplace when other people are maybe doing nothing.
So the idea is you're trying to generate income, but you have to protect yourself from these volatility spikes on the other side of it as part of the strategy. Is that the general idea?
That's exactly right. So think about it as like a ratcheting effect. So we'll make a few, then we'll lose a few, and then it goes to nothing. And then we can, redeploy that capital as we see the opportunity set. And then we can, again, short volatility in a risk-defined way so that we can extract income from the marketplace when there's absence of anything else that's interesting going on.
And so the idea is if you're in a red regime, then you're doing more things to protect yourself here in terms of what might happen with a volatility spike.
If we go from green to red in a day, so say for instance, there's some kind of geopolitical event that happens tomorrow and we go from green to red, that trade will lose money in a risk-defined way and those losses will be realized. Okay, that's just a loss. And then the money's gone. It's just gone. And we're willing to put on the size that we feel is acceptable. And then we don't really care where the VIX goes. If the VIX goes from 10 to 30 and it goes to 300, fine. Now we can short volatility at, 250 or something like that. So there's a whole new opportunity set next week that we didn't have this week. And yeah, maybe we lost 30 or 40 bips or maybe even, 100 bips on this one trade. But now we have this whole new situation going on when vol is high and the opportunity set is expanded, multiples.
Does the level of the VIX tell you anything about the opportunity for shorting volatility? Like some people might think like you when it's really, really high, you want to short volatility because it's got to come down. But I think I've seen some results that maybe like shorting volatility when it's really low actually can work really well. So does the level of the VIX tell you anything about whether the strategy would work or not?
No, the VIX is just a statistic. So if does the value of your thermometer on your porch tell you anything about what to do? Sometimes, right? So volatility does tend to cluster. If you look at something what's called a Garch 1-1 model, you'll see a persistence of volatility and there's some kind of a stickiness effect put into those equations. So which is to say that if volatility is low, it probably will persist and stay low for some period of time. And if volatility does spike, does it mean revert? Yes. And here's the tricky part. The tricky part is that everybody knows it's going to mean revert. So the options are priced accordingly. So the idea that, you want to buy puts in VIX when VIX goes to 100, doesn't really go to 100, but just say it does. And you want to buy the 70 strike puts. Well, what do you think the market makers are doing? Again, these are smart people. They know what they're doing. So those puts are really high. So the idea that you're going to beat the collective intelligence of Citadel, Susquehanna, Virtu, all these firms, it's not that likely. So you have to add way more levels of cleverness to that, or just have your opinion and be right or wrong in order to make money, because that's already priced in. Everybody sees the same thing that you see and probably more. So it's very difficult to just short volatility when it goes up, because the idea that it's going to go below some new point that you can see that nobody else can see, that's tough. That's a really tough trade to put on. So you have to be able to, it's about exceedance. You have to be able to do something above and beyond what's priced into the marketplace and have that trade executed. You have to do something that nobody else can do or nobody else can see in order to reliably make money or get lucky.
Do you see any value like in the VIX? Because the VIX is all over the media all the time. And I know whenever I talk to people in the options world, they'll look at things like fixed strike volatility and they'll look at things that are different than the VIX. Like, do you see any value of the VIX? Like, what should people make of it?
I see value in the VIX. I see value in the VIX, and it's really how it's deconstructed. How does the VIX move, and why does it move? Is it fixed strike volatility? Is it skew? Why is the VIX moving? And when I look at the VIX, I just look at it on my screen and say, okay, the VIX is at 30 today or at 16 today, and then I'll look at the VIX futures, I'll look at the options, and I'll try to dig down a little deeper. But it's a first port of call just to see, okay, what is the marketplace doing today in volatility terms? And then I will dig deeper if something interesting is happening. But the actual level of the VIX tells me almost nothing, and I almost never make a decision based on it. Where the real information comes from the options marketplace and the stuff that's actually tradable. Because the VIX futures price the VIX options. And it has really nothing to do with actual VIX, right? So there's a lot more complications in there, but the VIX is something I do glance at as just kind of like, okay, what's happening today? Oh, the VIX is up 100%. Well, I should probably dig deeper. But if the VIX is, exactly where it was yesterday or down 2 bips, I probably don't care.
I was going to ask this later, but I think it's a good time to ask it now. We all, those of us outside the options world, are hearing a ton about zero DTE options these days. And we're hearing all kinds of different things in terms of, is there a risk that the market's going to tank someday because zero DTE options are all going to go one way in the same day? How is it impacting what's going on? I'm just wondering, like, from someone inside the option space like you, how do you view the rise in zero DTE options and how do they impact what you're doing?
I think they're great. I think they give a lot more specificity to people's trades so that people can add exactly what they want. They can hedge exactly what they want, and they can get the exposure that they're looking for in a certain time slice. So the idea that, their options are expiring today is nothing new. Options have been expiring in a single day for my entire career, just not every day. We had expiration days all the time. We just had them, on the third Friday of the month. What's happened is a real artifact of that is a lot of the hedging flow has been pulled forward from 30 days or something like that. A VIX calculation is roughly a 30-day calculation. So what that does is it does reduce the accuracy of those signals in a 30-day tenor. So if you're bringing things from the future into the present, it does reduce the accuracy of future predictions. And the idea that you get these large implied vol shocks in a 1-day or 2-day tenor is definitely an artifact of zero DTE. But in general, what they're doing is they're adding a lot of liquidity. They're making the market an easier place to hedge. And I do not think that they are a weapon of mass destruction for the marketplace, because the market making community typically will hedge zero DTE with other zero DTE within some kind of parameters. So the idea that, I'm a market maker and I'm short, 100,000 of these daily puts by themselves with no other exposure, it's extremely unlikely that that ever really happens. They're just not going to let themselves get that kind of exposure where they're just going to blow out. And even if they did, so let's just pick on Citadel because they're big. If Citadel blows out today, does that really affect the country? Does that really affect, the world? Not really. And that's a pretty big event. The chance of them blowing out today is very, very low. But even if they did, it's not that big of a deal in the scheme of things. It's a very big deal for the people that are directly involved with it. But will it have this, knock-on cascade effect where the whole world blows up as a result of it? I don't think so.
I mean, I would assume places like Citadel are probably the most risk-managed places in the world, right? I mean, there's the level of computers and everything they have going there. I mean, whatever you probably can do in risk management, I assume they're doing it.
Exactly. And, as a market maker, I'll tell you, you just don't let yourself be exposed to where if the market moves 10% in the next 3 seconds, that you're going to be out of business. Usually the other way around. So I just don't think that's a large risk at a systemic level.
So I want to get into dispersion trading because this is something I think a lot of people see out in the media. Here's what's going on with the dispersion trade, but I don't think people necessarily understand what it is. So can you explain first what the dispersion trade is?
Sure. So dispersion trading is basically looking at the index of something and then looking at the parts of that same index. So say you have the S&P 500 and the volatility on it, and then you have the constituents, the 500 individual names that are in the S&P 500 and their respective weighted volatilities. So make it even simpler. Say you have an index and it's, Tesla and Apple. There's only 2 names in this index. There's 2 stocks in the index, Tesla and Apple. So in a dispersion trade, what you can do is you can sell the volatility of the index and then buy the volatility of the single names in a 50-50 ratio. And you can make money, in theory, 3 different ways. You can make money if, say, you're long volatility in Apple and you're long volatility in Tesla, and you're short volatility in the index. So if Apple goes up 50%, Tesla goes down 50%, and that means the index will do nothing. So you're making money on your short volatility of your index, you're making money on your Apple, and you're making money on your Tesla. That would be the dream scenario for that trade. So there is just this, again, this level of cleverness by taking something, deconstructing it into its constituent parts, and then identifying where there is value up and down that chain of ideas. And then using those relative values as a way to make money where, again, other people just don't see it. They just don't see the relative relationship between all of these 500 different names and their pro rata weighted value relative to what the index is doing. And if you think about it, the index is the first port of call for hedgers. So what happens is that there is this first mover effect in the index that people will buy puts or sell futures or sell index or whatever else to get out of the marketplace when there is a risk off event. So that means the puts are bid. That also means that those puts are high if the market doesn't crash. That creates just this natural persistent bid or skew in options where it creates opportunity if you can also be long the things that those options get their price from. It's a simple arbitrage trade. So if you think about something like, what is the price of a Honda Accord? Then what is the price of a Honda Accord in its parts? There is a relationship there. It's ridiculous to say that a steering wheel should cost as much as the whole car. So there is some arbitrage there between the constituent parts of a Honda Accord and their availability and their liquidity and the price of an overall Honda Accord. And that's the trade.
So we hear this idea that the index is pinned, and then we see a lot of things like moving behind the scenes in the index. That's what this is?
Yes. The idea that the index isn't doing anything, but the things that make up the index are doing a lot of something, that is a dispersion trade. Think of dispersion as, you take a handful of marbles, right? And you drop them into mud. Nothing happens. They're very correlated. They're very low dispersion. Then you take that same handful of marbles and you drop them onto a marble floor. But they're going to go everywhere. They're going to scatter like crazy. So what that is saying is that there's high dispersion, low correlation. They're going everywhere. They're doing their own thing. So when you have stocks that are moving in every different direction for whatever reasons, that is a very low correlation situation.
So when we see the dispersion trade is rising, what we've seen is a lot of people are betting on the volatility of the components of the index relative to the index. And that's been rising a lot in recent years. Is that right?
To say that the correlation and dispersion are the yin and yang of the same word. So think of them as being opposites. It's the same trade, just other sides of it. So if correlation is rising, that means more things are moving as a unit. Think of like a school of fish moving together, right? They see a whale and they go the other way as a unit. So that's correlation. So if the index moves as a unit because of a macroeconomic shock, then correlation goes up. And the other way around, say there is like something in the oil patch, has nothing to do with Tesla, has nothing to do with NVIDIA, then that's a high correlation trade because that's going to only be affecting like Chevron or Exxon or something like that. So that's only going to be sector specific or specific to a few names. Or, Tesla does something, smart or something stupid. That's a Tesla issue. That's not an ExxonMobil issue. So again, each individual stock might have problems or benefits, but that doesn't necessarily mean anything for the index.
And how do you think about running a dispersion trade like inside of your strategy?
Well, there's, saying dispersion trade, it's almost like saying, food. Okay. Italian food, Chinese food, Mexican food. What does that mean? There's so many different ways to put that on. And that's what I think a lot of people don't really understand. So you'll hear something like, well, Millennium has, $500 million of notional Vega I'm dispersion on. Yeah. Okay, fine. But in what way? And what is the correlation of those trades relative to each other? So how we do it relative to how a lot of other people do it is different. We're looking at how things will move from a macro standpoint, how things will move from a micro standpoint. How do interest rates figure into this? How does the macro backdrop figure into this? Where do we want to be in these names? And what we're trying to do is we're trying to find the cheapest volatility we can and buy it. And then we try to find the most expensive version of that in the index and sell it. And then we want, the highs and the lows to kind of do their thing. They wiggle through time and then they converge. That's the plan. And it's been an excellent trade for us. And I'm very happy that we have it on.
So you have an opinion on the macro environment above, which sort of informs what you're doing, like what might be happening with rates, what might be happening with inflation. I mean, is that part of what you do, is having an opinion on the macro environment and then carrying it down into your strategy?
So I trade bond options and futures. So it's impossible for me to trade bond options and futures and not see the price of interest rates. And it's impossible for me to do that all day, every day, and not have an opinion on that. So do I think that interest rates are going to affect the macro environment? I absolutely do. Do I think that interest rates are really the price of money and that will affect the price of stocks, options, and everything else? I absolutely do. So if I think that rates are going to go down at some degree more swiftly than what the marketplace is implying, and that can create opportunity within a dispersion trade, I absolutely do. Do I think that will affect financial stocks differently than housing stocks versus gold stocks versus whatever stocks? I absolutely do. And if there is a dispersion because of interest rates, then that will affect a lot of other constituents of that same trade.
So I should have asked this before, but when you put all this together, what you're trying to do is produce sort of an absolute return type strategy. Is that the way to look at it?
That is the point of my job. The point of my job is like, why am I here? What are these screens behind me, trying to do? They're trying to make money. It's just that simple. But I'm not any better at picking Apple stock price than you or anybody else. I don't have any better information. I have no alpha there. I have alpha in is I have a unique return stream relative to other investors because we see different parts of the marketplace. And that's the investment proposition. We want to put something together that other people just don't see.
And when you're looking at the individual components of what you're doing, you're trying to find things that are effectively uncorrelated with each other. You're trying to find these returns that are uncorrelated. So as a whole, they become a smoother return stream.
Correct. You don't need me to buy more SPY. If you want to buy SPY, go out and buy SPY, pay your 3 bips or whatever they charge you to do it, and that's it. So what we're trying to do is for investors that already have too much, access to SPY or whatever else they have, we want to come up with something that is low correlation to the marketplace or a dynamic correlation to the marketplace, because sometimes our correlations will go up, but they go down tomorrow, right? They can change all the time. And what we're trying to do is provide real alpha for people, which is to say something that's different. We want to make money. We want to not lose money. Those are like rule number 1, rule number 2, but we want to do it in a unique way so that we are doing something different. So when the market zigs, that doesn't really mean anything to us. Like we can zag too. It doesn't necessarily have a meaning for our book. It can, but it doesn't necessarily mean that.
So the goal is over time to look like something like zero beta.
Yes.
Okay.
Or low beta. Because there's so much market concentration right now, there's so much concentration in the marketplace, it is difficult to avoid beta. If there wasn't so much weighting to the top 7, beta would be easy to avoid. But because there's only a handful of names that are really going crazy, you have to have some beta if you want to be also participating in the equity marketplace.
So there's a couple more aspects of your strategy I want to ask about. And one is this bond vol arbitrage. That's something I'm not familiar with at all. So can you explain what that is?
Say you're making markets in the bond options. Say you're a market maker and you're making markets in the ZN, which is to say the 10-year note futures options. So what happens there is like this future, right? This future is the thing, the thing is a bond. And then there's the options on those things. So what you're trying to do is the same thing you're trying to do with everything. Going back to my BMW analogy, you're coming up with a fair value of an option, and then you're making markets around it. So what we're looking at the surface of the bond volatility, not the yield curve. Okay. So there's the yield curve, which maybe is the x-axis, and then there's the volatility surface, which is maybe the z-axis. And that volatility surface has options in it. And what we're doing is we're looking at historical moves. Think about them as macro earnings. Like a Tesla earnings will give you some kind of an event, but maybe a non-farm payrolls will give you a different event because it's macro. And we're looking at how much volatility is being priced into the bond market at any one given event, just like an earnings trade, right? Bonds are priced in ticks, not dollars. So say, the straddle is 15 ticks and you think that's too high. So you sell it. And then, but because you don't really know if it's high or low, you'll also go somewhere else on that volatility surface and try to buy volatility somewhere else to hedge it out. So what we're doing is we're looking at the bond futures options. We are overlaying our own volatility surface onto what the marketplace is showing us. And if there is a disagreement, we trade it. And if there is no disagreement, there's nothing to do. We are simply looking at disagreements between what we think should happen and what the marketplace thinks should happen.
When you think across your strategies, how much of this can be done quantitatively and how much of this is your experience as an options trader and your discretionary input into it?
The question oversimplifies the reality, which the reality is that the experience informs the quantitative aspect of it. Code is just the output of ideas. And those ideas come from wisdom, and that wisdom comes from time and experience. So a lot of what we do is mechanical and codified, but there is always some portion that is dynamic and always new that we have to be at the ready. And it's not just a black box that just does its thing and we have no idea how it does its thing and it just spits money out the other side. We have a blend of discretion and a blend of quantitative parts of our business, but the quantitative part is probably 80%, but the 20% is very important because we have to know when things are different because we know what the inputs into the model are, where they might fail.
It's funny. It relates to my world because I'm a factor investor. And I'm doing much longer term things, but people always say, well, you're a factor investor, so you've eliminated human discretion from the process. And that's the opposite of the truth. I mean, somebody is building the model. Somebody is deciding when is the world change and I need to change the model. Like there's no way to get away from the fact, to your point, that human discretion has to play a role in this.
Exactly correct.
You have an opportunistic thing you do, which I think is very interesting on top of all of your other strategies. And so I guess the idea is when you see some special situations, you will, outside of your normal strategies, you might do something with it. And so can you just explain a little bit about what that is?
Yeah, there's all kinds of little things that happen in the marketplace that we want to take advantage of when they come up, like GameStop, Open Door, things like that. So when GameStop was going crazy, we were shorted at like 27. We were shorted again. We covered for a loss. We shorted again at like, I don't know, 40 or something. I forget the number. And then shorted again at like 67. We took loss. And then we were long it above 67 and we wrote it to like, 480 or something like that. And what we were really doing in those types of trades is we were buying call spreads for almost nothing. So think about what was happening in GameStop or other meme names. People were buying the single highest strike that was on the board and they're just paying whatever. Say like 25 cents for an option that was probably worth a penny. But what they weren't really looking at is the next lowest strike. So I would sell these options for like, 25 cents, but I could buy the lower strike for 25 cents. So I'm basically getting a free call spread. Well, how many times would you do free? How many free lottery tickets do you want? I'll take a lot of those because if they're free, I'll take them all. So we basically are buying these call spreads one at a time because nobody's going to sell you a call spread for nothing, right? That makes no sense. But the marketplace, if you're willing to take leg risk, which is to say, sell one, buy one, sell one, sell one, buy one, and you're doing this as many times as the computer will let you do, you will net have on thousands of these spreads for no cost other than maybe commissions, which is de minimis. So if the stock does work out, you can basically make, each one of these spreads can go from $0 to $1. And if you're doing that up and down the options chain, you can make a lot of money. And you're doing that with almost zero risk. And that's what I call opportunistic trading. We're doing things that are unique and don't present themselves all that often. But when they do, you can make really good money. And not only that, but a lot of times you can do this for a credit. You can, because the bid and offer on some of these options are so wide, you can get paid to put these spreads on. How many of those do you want to do? Infinity. Why would you not do that infinity times? The only reason you wouldn't do that infinity times is because you can't. You don't have the systems to do it. We do have the systems to do it. And we just do that as much as we're able to. Now, the bad news is nobody's going to do that, a billion times, right? That happens, 500 times, 1,000 times, a few thousand times. But that's about it. That's the most you're really going to get.
So a couple of questions with that. What was it like being behind the scenes inside of GameStop? Because just for me looking at the stock price, it was a crazy situation. Like, what was your take being behind the scenes and actually being involved in it?
Yeah. So what was happening is volatility was just exploding. It got to the point where at its top, I think that the $500 straddle was like $480 or something like that. I'm going off memory, so I could be wrong, but I'm not that wrong. So the idea that GameStop was either going to go to 1,000 the next day or to 0 the next day, I'm like, well, man, that's a lot. So, the pricing got to be so absurd so as that the market makers, again, think about the market makers. Who are these people? Who is this cabal of invisible people that people talk about? They're just dudes that don't want to get fired. And they have models and they're just saying, okay, well, I got wrecked on GameStop for the last 3 days in a row. I can't get wrecked on this again. Otherwise, I'm going to get fired. So I'm going to raise prices and volatility so that any volatility that I sell now is like almost a lock to make money, no matter what. So it's like going back to my BMW, analogy. How many BMWs do I want to buy at 0? Oh, I'll take them all. Fine. Because I'm not going to lose that much money if I pay 0. Or the other way around, if people are paying, $60,000 for a BMW, now they're paying $500,000 for a BMW. Well, how many BMWs are you going to sell at $10,000 or, $10 million and they're worth 50 grand? A lot. You'll sell all of your inventory. And it's the same thing. If you got wrecked one way or the other, the market makers will just move their prices so as to guarantee future profits.
One of the interesting things to me about this, and this is something that I think applies to all investors, is this ability to change your mind. So you were mentioning with GameStop, you were short it, you're wrong. You were short it, you're wrong. You're short it, you're wrong. And then you're long it and you're really right. Like, I'm wondering, based on your experience in trading, is there anything you've learned in terms of like your ability to change your mind, your ability not to be married to a certain position that might help everybody?
I am never married to a position. If you are married to a position, you got to know something that the public doesn't know or you just have to be an emotional person because I've been wrong innumerable times. I'll give you an example, like Herbalife. So I got the same, short thesis from Bill Ackman that everybody else got. So here's the funny part of that story. So I was living in LA at the time, and I was like checking out houses, and the real estate agent I was working with was like, "Hey, do you want to go see this house up in Beverly Hills?" I'm like, "Okay, sure." And so we go to the house. I'm like, "Yeah, it's a pretty nice house. I don't think I can afford this." And I asked about, I'm like, "Who's the seller?" And like, "Oh, it's the guy that owns Herbalife." I'm like, "No way." So now Bill Ackman's saying that this company is a fraud, and the dude is selling his house. I'm like, "No way." And what happened to Herbalife? It went up. I mean, that's great information. I mean, if you look at the Bill Ackman story, it's completely compelling. The guy made a movie about it. It's the best story ever. And then the guy is like trying to fire sale his house, and the stock goes up. My point is that no matter what you think can happen, it can go against you for a while. And if you can't stomach those losses, you're going to be out of business.
I remember back looking at that Herbalife thing to me too, and it was just, it seemed like the most obvious thing in the world. But I guess, and sometimes you can be right in the long run, but if you have the timing wrong, you're not right. And I guess that's something else you have to learn with all this.
Exactly. So I cut my losses short really swiftly. If we have a trade on, to me, it's a ticker, right? I've seen so many tickers come and go. I really have no passion for a ticker, and I don't really get mentally involved in something ever. And, the idea that, something should do this or shouldn't do that. I mean, look at Tesla. How many guys got blown up being short Tesla? A lot. The investment thesis for being short Tesla at certain valuations was compelling. It still hasn't come down. Those guys are still out of the money on those trades. So, the idea that you can be married to a trade and you should just stick to your guns, you can do that if you're sized right. But if it's too big, you'll blow out.
One more strategy I want to ask you about is tail hedging, because this seems like a very interesting or challenging strategy to try to run, in that you want to protect from the major events, but also what they call the bleed, which is if you're doing this over and over and over again, you just have these small losses that accumulate. So how do you think about like running a tail hedge, around the rest of your strategies?
Tail hedging book is a very specific thing. It is not a money-making operation. It is a drag on our P&L overall, and it is not something that makes money overall. It is there to smooth out the overall P&L in the event of a drawdown, but it is not something that has benefited our P&L. It's been a loser for us overall over time. Does it help every now and then? Of course it does. But every now and then is not all the time, and I'd rather make money all the time. So what we're doing in a tail hedge is we're specifically trying to mathematically show our investors that we have no ability to blow out, which is to say, tomorrow, nuclear missiles are in the air. What does that mean to us? Well, we can't blow out. No matter what happens, we can't blow out. Can we lose money? Of course we can lose money. But can we lose, 100% in a day? It's not mathematically possible. That's why it exists. It also exists as a bit of a marketing part of our book, the sense that we can show people that, there's just no way we can lose a ton of money. But there's a price associated with it, and that price isn't zero. The idea that anybody is going to sell you insurance for zero and not have it cost you something, I have yet to see that exist in real life. So whenever we do a tail hedge, we try to do large asymmetry, which is to say, we'll spend $1 to make 15 or 10 or 5, but it is always a spend of something to get some kind of insurance in the book. And it is not something that overall makes money.
And I think one of the things I've learned, I don't know if you'll agree with this or not, but the benefits of rebalancing are huge with these tail hedges too. Like your ability to monetize it and put it back into your other strategies when you get the tail event can, I think, offset some of the cost of it.
That's exactly right. Well, going back to your earlier question about VIX. So how did I trade the tariffs versus the yen carry blow up in last August? Those are totally different things. The VIX gave different information on both of those vol on events or, risk off events. So if you deconstruct the VIX into how does it move and why does it move, you would say something like you should fade the yen trade, which we did do. And I think I was talking to Jack Farley that day, and he's like, there was the morning of, and he's like, hey man, what are you doing? I'm like, I'm selling this thing. I'm out. I'm monetizing my hedges, and we're going to take this money off the table. And then the opposite of that was the tariff stuff. When vol went up on that, we didn't monetize any of that in the beginning, and we actually added a little bit, and it worked out fine too. So that is, if you have to be able to see vol is moving, but why is it moving? And is it going to be sticky or is it going to be persistent? And that's part of what I get paid for, which is to figure that part out.
This is probably somewhat of a dumb question because it doesn't relate to my world as much, but so in my world, we think about position sizing a lot. We own a certain stock, we own a certain other stock. We think about our weights between them. Here, you've got a group of strategies you're running. Like, how do you think about how much capital to deploy to each of the strategies in terms of creating like an overall portfolio?
That's a great question. Nobody's ever directly asked me that. So it's no different than what you do in the sense that, say you have 10 stocks in your book. How do you figure out how much you want of each stock? What's the weighting? And we have, 6 strategies in our book. How do we figure out how much we want to weight those things? Well, because they have some kind of correlation, we look at the mathematical relationship of those things and we look at why they're changing. And then we do the same thing. We try to put more money on something we feel is more depressed. It might be mean reverting, or less money on something we feel like there's asymmetry to the downside. Like right now, our dispersion trade doesn't really have that much money on it right now because dispersion is I don't want to say at a low because it can go lower and it can stay low for quite some time. But I don't think that the opportunity set for dispersion right now, September 30th, is all that great. Could that change tomorrow? Of course it could change tomorrow. But because of that, we are underweighted in that trade. And that's the exact same type of concept, which is we want to have more money on something we feel has got a better chance. Same idea as if you think that Tesla is going to outperform Microsoft, you put more money on Tesla. Same idea. But how we get there is different. But the actual, the common sense part of it is we want to have more money on something we think is going to do better.
So the allocation could vary a lot over time depending on where you're seeing the opportunity.
Yes. And this really goes back to the beginning of our conversation, which is, okay, I'm backing 100 guys. All right. I've got, all of these dudes out in my office and, some guys are trading different things, gold, hogs, stocks, whatever. And, as you're looking at the overall firm-wide portfolio P&L, some guys are making money, some guys are losing money. There's, some guy today is getting wrecked, another guy's making a ton of money, but, most guys are kind of in the middle. The same type of thing happens to everybody's stock portfolio any one given day. And then once you start to distill that into its useful parts, you figure out, okay, well, there is no one time and place where ExxonMobil is always going to be the best stock in the stock market, or Tesla is always going to be the best stock in the stock market. So you have to try to figure out why those things change and when to be in front of that. And we do the same thing we did the same thing with our traders, which is to say, we had a guy in the Eurodollar pit. Well, if interest rates are in question, Eurodollars might be a very good place to have a guy. But say interest rates are at 0 and there's nothing happening. Well, Eurodollars might go away and turn into SOFR. It's a totally different business. So then we would remove capital from that trade. And we do the same thing in our ideas, but we have a different way of looking at it. But the idea is we're going to dynamically allocate to everything. There is no one size fits all the time. The trade is always on. It's always going to work. And there's no reason to ever change the size. I think dynamic allocation or tactically investing is a superior way to make money.
I have to ask the obligatory AI question because I seem to ask that in all the episodes, but how do you think AI will impact what you're doing, or is it impacting what you're doing?
It's making our research easier and how we get to what we want to do easier. So sometimes we have an idea, we want to construct a new model. It can help us. It can help us with coding up our ideas or checking our stuff. But we have yet to, ask ChatGPT, hey man, what do I do in this stock? Or what do I do here or there? I'm not saying it couldn't, but I'm saying it hasn't yet. So has it replaced me? Not yet. I don't know. It has been a really nice thing for answering questions, getting research, or even brushing up on things that I forgot 10 years ago. But it has not given us any alpha yet.
I think that's a pretty consistent answer we've heard, like across all kinds of different kinds of investors. I'm learning a lot. My research is getting better because of it, but it's not better than me right now. And who knows? I mean, I guess we'll see in the future.
Yes.
So thank you. This has been really great. We have a couple standard closing questions we ask all our guests. And the first one is, what is one thing you believe about investing that the majority of your peers would disagree with you about?
The idea that the most you can make is like what a top hedge fund makes. So the idea that, you've got, Bridgewater or whatever, and they make, 9% a year. So if Ray Dalio and his group of, eggheads can make 9%, what's the chance that you can only make 9%? That's total nonsense. There's all kinds of prop firms out there that make hundreds of percent per year. And just go to the news and look at Jane Street, look at Optiver, look at these prop firms that are just printing money year in, year out. And the idea that you can't time markets, that's also not true. You can totally time markets. So I would encourage people to learn more and try to figure out how to make money in the marketplace, because there's tons of opportunity once you figure out what your niche is. So just the overall idea that I can't make money, everybody who trades options loses money, not true at all. tons of people make money consistently trading options. I'm one of them.
And our last question is, based on your experience in markets, if you could teach one lesson to the average investor, what would it be?
Okay. One lesson I would honestly, this is, I keep going back to the options market. It's also where I'm from, but I have, sniffed around in other trades for many years. So I've looked at other trades and see how they like futures or, just equities or whatever. And I keep going back to the options market because again, I think it's some of the most informed paper out there. And so I would tell anybody who's watching this to get a better understanding of what the options market is telling you or not telling you and how to use it to your benefit. Even if you have no intention of ever trading an option, you should understand the options marketplace has a very large impact on the overall marketplace and can be very useful as a way for you to make money. That's kind of what my entire business is undergirded by. And I think there's so much value in that. I decided to, stake my future and my family's future on it.
That's interesting because that's basically the reason I do the show with Brent that I do, is because I've never traded an option in my life, but I've learned so much in terms of what I'm seeing in front of me in the market based on looking at what's going on behind the scenes in the options market. So I would definitely echo that. Well, thank you, Noel. It's been great having you on. We really appreciate you taking the time.
Thanks for having me today.
If investors want to find out more about you or what you do, where can they go?
So we have a website. It's Convex Asset Management. So it's convexam.com. I'm on Twitter at Noel Convex. And, we have a website. You can reach out to us there.
Thank you, Noel. Appreciate it.
Thank you.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.